Hello, everyone, and welcome to the latest webinar from Capron Asia in our 2021 series, brought to you by Capron Asia and CBOE. Today, we're taking stock of the U.S. equities market in 2020 and beyond. In many ways, 2020 set a new normal in many aspects of the financial industry, and the equities market was no exception. Recently, we passed the anniversary of the lows of the market of last year, and since then, we've seen an 80% growth over the past year. Numerous different topics have kept the headlines active around things for paying for order flow, meme stocks, and many other geopolitical issues that have really changed the nature of US equities markets. A key element of that is being able to access those markets and trade those markets, which is really what we're here to talk about today, is both what happened in 2020, what to expect in 2021, and what the implications are for Asian traders. To round out this panel today, we have a great lineup. First of all, we have Adam Inzerillo from CBOE. He's the Senior Vice President and Head of North American Equities. Chris Carlin from Morningstar Asia, who's the Head of Alliances, Redistribution Solutions, and Data Products for Asia. And James Alexander, who's the Chief Commercial Officer of Invest Global. Just a couple of housekeeping rules before we get started. This webinar is on mute for all of the delegates, but we do have questions and answers. So if you do have questions for any of the panelists about the topics that we're looking at, please do use the Q&A functionality within Zoom to ask those questions, and we will insert them as we go through the discussion. As well, if you have any other questions for us that weren't covered, we'll have contact details that we'll share with everybody who's attended the webinar, and a recording of the webinar will be made available shortly afterwards if you missed anything or if you want to listen again or share it with colleagues. Before we get into the discussion today, I just want to have a quick poll to start us off. And so the question is, which international markets or data sets is your firm currently accessing or looking to access in the next 6 to 12 months? I mean, a number of different options there. So as we get started in that polling, let's just go through brief introductions from each of the panelists. Maybe Adam, we can start with you. Tell us a little bit more about yourself, your role at CBOE, and really what your role is in kind of this ecosystem that we brought together on the webinar today.
Yeah, sure. From my perspective at CBOE, I've been here for about 16 months. Prior to that, I had various capacities at UBS Investment Bank, as well as Bank of America Merrill Lynch, most recently Managing Director and Co-Head of Electronic Trading Products. An interesting element about being at exchange is you get a totally different perspective of the overall market. You get a different view of who the main market participants are, where the liquidity providers, those of whom that are having passive orders, where do they come from? In addition, some of the marketable order flow that makes its way to our market, and we have a good understanding of who they are and what they do in that capacity. CBOE's perspective is really to kind of cater to all market participants, and I think it's kind of dispel a lot of myths and rumors that are out there. Particularly what you've seen over the last couple of months, there's a lot of emotion driving some of the, the rhetoric that comes out through media and other political elements. And I think it's very important that we take a step back and view these things in context. So CBOE, first and foremost, takes a very objective viewpoint on that. We leverage data to make informed decisions. And then number two, we want to provide innovation through order types like retail priority, periodic auctions, which we're now bringing over to the US, as well as some other institutional order types like QDP. So again, focusing on innovation to drive that change. And then lastly, we want to be a voice that provides content and again, an objectional view that allows us to have proper dialogue with the regulators and our constituents that come to the marketplace with various product offerings, as well as a voice of reason, where, many of our peers and others, kind of just point fingers at one another. And, CBOE's view is really just kind of provide an objective viewpoint into the overall market. And so that's something that we've tried to instill over the last, 16 months. And prior to my arrival with BATS, being the leading technology provider in the U.S. equity space, and then through the merger of CBOE, we are now a diversified asset class, global transaction network that brings significant value, not only just to the US, but to all other market centers globally.
That's great. Thanks, Adam. I think that point about objectivity is really key, considering everything that went through over the past US administration. Objectivity was something that was in short supply. So that's going to be great, especially when we talk about some of those topics like myths and some of the controversies that have surrounded equities in particular in the US over the past year. Chris, let me come to you. If you can give us a brief intro on yourself and your role at Morningstar.
Sure. Chris Carlin, Morningstar, Head of Data Products and Alliances for the region. I've been here about 5 years. Prior to that, I was with Thomson Reuters for about 17 years. I've been in Hong Kong 14 years in total, looking after the data feed products for both companies across the region. What I see in kind of regards to our topic today is well, I notice it's sort of regionalized when people look at US equities. So in Japan and Korea, I notice they're not looking at equities, they're looking at mostly ETFs to enter the market. So the brokerage companies, banks that we're speaking with. And then in Hong Kong, Singapore, the driver is US equities itself. And probably language is one reason. It's easier to diversify directly into an ETF as opposed to maybe doing all your research in the language that's not your own. But we saw a lot of access being granted, especially in Korea and Japan over the last year in 2020. And we're still seeing a lot of that interest being driven coming into this year. So I would say it's been driven by China and still Korea this year, a little bit in Hong Kong. So I expect it to grow and grow. And I think one of the things that firms need to look out for is, not only having your data, but do you have your counterparty in place? Are you able to execute, transact, get the best prices for your customers? And then how do you fight for the market share for people trading US markets or overseas markets in general? So that's been my perspective around the last couple of years in this space.
It's very useful. That point, you brought up the idea of language being an impediment for trading some of these. And so some people opt for ETFs as opposed to individual stocks. I mean, a number of the studies that we've done of Chinese retail investors is, although they invest in foreign markets, they tend to invest in the names that they know. And the platforms that they understand, so the Baidus, the Alibabas, the Tencents of the world. So although those may not be listed in Chinese markets, listed in overseas markets, is that something that you would extrapolate for countries like Korea and Japan, where it's not just language, but maybe understanding as well?
It could be understanding as well. I would say from our perspective, they're not taking equity market data and they're really focused on ETF data. But I do agree with you. I think when you look at even just Hong Kong and Singapore, the stocks that people have the most interest in are your Tesla, Apple, Amazon, the names that they know. I don't think people want the whole tail of 14,000 US companies that are traded in the public market. So it really is focusing on the S&P 500. Most of these firms could probably get away with offering that level to their customers, but they do want to be competitive and they do want to offer something different. So that's when they look at data beyond the exchange published data, and they'll look at it to supplement to help their customers, make more informed decisions.
Got it. Thanks, Chris. James, coming to you, if you can give us a brief intro and about Avast, and maybe you can pick up where Chris commented there of the demand that you're seeing from the clients that you work with.
Yeah, absolutely. So James Alexander, been at Avast down here in Sydney for around 8 years now. We're a multi-asset prime of prime broker, which means we fill that intermediary space between your traditional prime broking, your tier one prime brokers, and the direct to retail type of brokers. Our clients generally include medium-sized and smaller hedge funds and asset managers, as well as the retail brokers themselves. So we've got a large and very diverse retail broker clientele base, which means that we've got a somewhat unique view on the market because we really have a direct line of sight to retail without being directly involved in it ourselves. And that's somewhat of a unique perspective, especially when you sit across multi-asset. We see futures, FX, fixed income, and very much equities. And that equities piece has been the piece that's really sort of taken the attention in the retail side, particularly over the last 18 months. I can 100% echo Chris's previous comment about ETFs. I think that the rise in prominence and trading volumes of those ETFs, particularly here in Asia, has been really astounding, to the point where it's almost considered a different asset class entirely from single stock equities. So, those conversations in the retail space are evolving, and they're evolving very quickly. And I dare say that in Japan, where we have a listed parent company and we're originally headquartered, that rise in prominence of ETF trading is only going to grow. And I think that is very much a global macro sort of focus, particularly focused on the US, Europe as well, but US with the primary focus there of interest and capture of turnover and notional trading.
That's great. I mean, that rise of the ETFs, I was going to ask you what you expect for the future on that. I mean, would you echo Chris's sentiment about, the understanding of the underlying asset, or I mean, Australia, maybe not so much language issue when it comes to trading US equities, but
Yep.
what from your side do you see as the key drivers for ETF adoption and interest?
Look, amongst the retail traders, we sort of see a split. We see a split among thematic lines and many ETFs. You've got your index tracking ETFs, of course, but many ETFs now are coming out and catering to a more of a thematic stance. It's a story, and a story cuts across language far more quickly and acutely than, a story about or a message around a single stock. So I think, those thematics, those themes, those stories, which have been really strong over the last 18 months. I mean, the pandemic story, the recovery story, the vaccine story, these are all things that people around the world can relate to. And I think that, where there is a story that is easily understandable and digestible, you've got the opportunity for people to engage. And as soon as they engage in a financial market sense, they want to be involved. I think the split that we've seen there is there's those investors who have really engaged on that thematic level. And then there's the investors that have gone, and maybe those with, and again, I'm sort of focusing on the retail side for a moment here, with a little bit more experience in the markets that have delved down and gone to the individual stock level, but are doing so on more of a society-based, a community-based investing approach. And, I'm sure we'll come to it later in the webinar today, but, a lot of the Reddit groups, the Discord groups, these sorts of, social or community-based investment strategies have really taken off in the last 18 months. And we certainly see that through the distribution channels that we have into retail.
And just the topic here is US equities as well, but I mean, just specifically around Australian equities markets, are you seeing a lot of the same trends replicate in those markets as well, just as a sense of comparison?
To a smaller extent, yes. We're a smaller market down here, both from a demographic perspective and the equities market itself perspective. But yes, we are. Certainly community-based investing has been taken up here with as much vigor, I think, as elsewhere. It's a smaller cohort. But I think this is, from what I see and from the distribution channels we have throughout Europe as well, this is definitely a global phenomenon amongst retail.
Definitely. I just want to share the results of the poll. So the question again was, which international markets data sets is your firm currently accessing and looking to access? And clearly, amongst most of the attendees today, US equities, represent 78% of that. A big, maybe staying with you, James, to start off onto our next topic here, a big part of US equities is obviously market access and the basics of trading US markets. I'd like to go to all of the panelists on this question, but maybe James, we can start with you. I mean, you're sitting in Australia, many of your clients are there or in Asia Pacific. And what are their options for accessing US markets, both from the retail perspective and an institutional perspective?
It's a very broad question, so I'll try and be brief. The spectrum of access options is actually much broader than many people think or understand. I mean, if you start right at the top with the tier 1 PB sort of market access, which includes the plumbing, the connectivity, the smart order routing, embedded financing, these are all options that are available. The other end of the spectrum, of course, is you have your, the Robinhood style investing for retail traders, ubiquitous names like Interactive Brokers, of course, as well. But I think what's less well known is the spectrum in the middle, the interdealer brokers, the prime of primes, such as ourselves, that really bridge those two worlds. Because for your larger hedge funds and tier 1s, obviously a tier 1 prime broker is going to represent a very compelling option. For your direct to retail, I think the traditional broking houses throughout Asia, particularly, and those in Singapore and Tokyo, have and maintain a large share of wallet, but there's a lot of access options in the middle for those smaller, those medium-sized managers or the more sophisticated traders to access markets in perhaps a more bespoke way, whereby things like market access and the way in which orders are handled and routed can be more customized, and which packages up market data options. A lot of brokers will focus only on the execution piece. A lot of brokers will attempt to integrate certain components of market data. And I think in this day and age, those brokers that work with the data vendors, such as Morningstar and others, are really going to be at an advantage, because I think more and more traders are going to want a packaged solution whereby the market data can be well tailored with the market execution piece, including anything that might be required there, such as smart order routing or these sorts of more strategy-based execution methodologies, that sort of customization is going to be more and more important. So that's sort of where we sit, and they're the two areas where I think people really need to best appraise themselves. What do I need? What is a right size solution for me? Do I want to take an off-the-shelf data solution, or do I want to get something more bespoke? Do I need to focus on my cost of execution? For retail traders, is it simply free is best? Or is there greater considerations there? One thing that personally we see internally within Invast over the next 12 to 18 months is the optionality. What options are being presented to retail? What optionality is being given to the hedge funds, the smaller hedge funds, especially those here in Asia as well, around the way they execute. And for us, it's not about right or wrong or which methodology of execution is best or which venue is best necessarily. It's about presenting clients with well-informed options.
That's an interesting point. I mean, just a follow-up question on that. I mean, with options, so you might be able to tell from my accent, I'm American, and so I've used E-Trade for 20 years. I've used TD Ameritrade and all the other online discount brokers, and to a certain extent, there's a little bit of commoditization around that at the moment. Whether I trade on E-Trade or TD Ameritrade, I'm still getting zero cost execution. I kind of guess at what the best execution is going on in on the back end. But I mean, what do you see, especially when you get into an environment like what the U.S. is now, and kind of what's spreading around the world of zero fees around trading? I mean, what do you see as the key points of differentiation that a retail investor might notice in these platforms?
Yeah, it's a really good question. And I think what we're seeing now is a differentiation in the user interfaces, i.e. these, the apps, the mobile engagement, which is becoming more and more important, and which quite successfully has taken the limelight or the focus away from other components of execution. Now, for retail traders, I think that net the benefit is still very positive. I think their access has never been better. I think the way in which they can engage, the order types, the ease of account opening, things like that have improved. However, I do think that in the last sort of 12 to 18 months, some other aspects of that retail trading experience have maybe suffered because of the, the focus on, the application or, the way in which that's presented to clients. So, I think a key point of differentiation to your question going forward will be tying in really digestible data analytics. And this is what we're starting to see now. Brokers ingesting, data and analytics teams. They're trying to source data from, other vendors and indeed exchanges that is usable and that they can break down and present to clients that shows the value add. If you're going to charge for commissions in the US to a retail trader, you need to justify why it is that they need to pay with you and why they're not paying with your competitor down the road. And if you're able to do that succinctly, I think there's absolutely a market for both.
That's a good point. I mean, a lot of this is, for many retail traders, including myself, it's very theoretical, but seeing that actual price improvement or what the advantage is that you're providing is very critical. Adam, I want to come over to you. James talked about data analytics as well as the customer experience. Maybe can you talk a little bit about the technology? I mean, what is the technology that's available for market access for U.S. equities, both on the institutional side and the retail side, and how has that changed over the past couple of years, and where do you see it going in the future?
Yeah, I think, it really depends on the style of the customer that wants access to the market. Not everybody values direct access to the bid or offer. I think if you look at it in two segments, it's retail, right? And that I would look at as more the individual investor, not the systematic type retail trading firms. Those of whom are individual investors, they want easy access to the market. They see the stock bidding at 10 or offered at 11. That's the price that they want to be able to receive. And, it's an easy way for them to get access to the market. And they could do that through a number of ways. They could do that through web. Now you have mobile access. So it's easily at their fingertips. And then I think you have some of the more sophisticated traders that leverage other brokers and intermediaries for access to the market. And they play a valuable function in the market, regardless of what we kind of hear recently. Brokers provide a lot of value that exchanges can't do. And I think one of the things that people tend to forget as an exchange operator pursuant to the Exchange Act of 34, there's some things that exchanges are precluded from acting in a certain capacity or manner. So for example, one of the value adds of intermediaries, for example, is if I'm a Midwest investor and I want to buy stock at 500 shares and it goes to a wholesaler and I meant to be 50 shares, the wholesaler can step in and provide that principal capacity where an exchange cannot. So most of the individual investors will go through an intermediary to get access. What we have seen with some of the increased volatility and increased volume and message rates, we have seen a number of firms come directly to us. We've also provided some, innovation for some of the non-marketable limits to come to our market. On the institutional side, intermediaries are of extreme value, but a lot of brokers today now offer various means for access to the market. If I want to trade VWAP or TWAP, I can go through an electronic trading suite. If I want, just simply go out and find the best price, whether it goes through non-displayed market centers or public market centers. I can leverage a smart order router, or there are a number of quant funds and systematic hedge funds and others that will leverage FPGA, which are hardware-based solutions, or software-based solutions where they don't want to develop all the coding and the technology and the certification on their end, and the intermediary will provide that function. So FPGA is something that's fairly new and robust that a lot of brokers offer. They also, not only just in the US, this is also offered in Canada. You see this in LD4 in Europe. You also see this in HK Connect. You'll see this in Australia, and you also see this in Japan and a few other markets where FPGA solutions or hardware-based solutions are huge. It basically allows you to have the risk check all built into the solution. You can do that in like 380 nanos. So I think it depends on the market participant and how they want to access the market. I think individual investors are just more concerned about what's available on the screen. Institutional investors will vary dependent upon the parameters and the characteristics of the orders. They could leverage electronic trading suites. And then in addition to that, there's some pretty fast and efficient means to access the market through various products like FPGA.
Thanks, Adam. I mean, following up on that, you mentioned kind of what's changed for the retail and what's changed for the institution. And I think when you look at both sides of that, I mean, speaking on the retail side, the fact that many of these platforms and brokers are going to no fee, the fact that many of the customer experience is now shifting to the mobile, so I can be on the train and trading stocks. And then on the institutional side, you have more of the access to that technology. On which side do you think you've seen the biggest technology change over the past couple of years? I mean, it's been impactful on both sides, but in terms of changing the nature of how either retail or institutional are trading in the market, which side do you think has had the most impact over the past couple of years?
I would, it's probably not the, consistent view, but, based on, my prior experience and what I've experienced on this side, I think the institutional side has gone through a dramatic change about how it accesses the market. If you go back 5 to 7 years ago, a lot of the access to the market was based on historical information. So, if there was a 30-day average that basically said the majority of my, passive liquidity I could find in venue A, the reality was, when you sent the order to the broker, they would go to venue A. Now there's a lot more real-time signals that drive that market. In addition, a lot of brokers will go to the institutions and say, don't use a limit price. I can develop a fair value signal that can no longer have you constrained to your price that you provide to me. And as a result, that I can provide some better performance. So I would say there's a lot more intellect and empirical data that's driving a lot of decision making on the institutional side. I would say the greatest change, though, on the retail side has really been zero commissions, and we see that in the composition of the U.S. market. And just to kind of put that in perspective, 30% or roughly, actually a little bit more than that, about 33% of all U.S. equity trading is for stocks below $5. And if you go back, prior to pre-COVID, late 2019, that number was about half of that. So you can definitely see a rise, in lower price trading, which, a lot of folks that want to get active in the capital markets, they may not necessarily want to go in and go buy Amazon or Google at their expensive price. What better way for me to access the capital markets and leverage, some of the low price securities? So we've seen that composition change. So institutional, a lot more empirical evidence, signal driven, model driven about how they access the market. On the institutional side, on the retail side, I would say the biggest change has really been zero commissions and allowing more market participants to access up capital markets. And you can see that clearly with, the value of the stocks that they're trading today versus say like a year and a half ago.
Yeah, and I definitely want to come back to that zero commission and the value of the stocks and what that means for the markets. Chris, I want to come to you. I mean, a critical part of both what James and Adam talked about is obviously market data. Can you talk a little bit about data access in general for U.S. equities and typically the way that Asian investors would be accessing that market data, as well as James brought up the idea of data analytics. I mean, that's a key part. The market data is a key part, both actual and historic data, for feeding into those data analytics. Can you talk a little bit about how that has evolved?
Sure. So from a Morningstar perspective, it's obviously easier for me to talk about. What we saw was when people started accessing US data, they were doing it via web, I think for the front end. So they were just happy to take a snapshot service. The retail user logs in, requests a price, probably on a mobile. Certainly now it's 95% mobile that we're powering, where even when I started 5 years ago, it was mostly web. And then on the back end, they'll take a streaming feed and they'll try to connect directly to the market. So we have that infrastructure set up where they can access that way. So we see a combination of both. What they're offering on the front end is slightly different than what they're offering on the back end. And I think to the point of analytics, they're looking really at the front end for that. So I think what they want to know is being able to offer technical signals to their customers. So having things like VWAP and built in, moving averages and advanced charting features that they're building on top of that. So they're doing a lot of that value add, usually not by themselves. They're bringing in third parties. That's their expertise to build those types of signals built into the data feed that we're providing. And they're trying to outdo each other. So it really is very commoditized, and it's so much so that they're looking at other data sets that they can offer to add insight and analytics to their customers. So some of that might be forecast data, some of it might be operating metric data, regional, who has a great presence in China, that sort of information. So maybe a macro play on top of the data as well. So, and they'll blend it with things like FX and other information that can be provided to customers to then do some deep dive analysis for those that want to offer that or to do that as part of their researching. And then we also see some of the data sets that Morningstar offers, which is like equity research, quantitative models that we've used, that we've developed over 15, 20 years, and having that as an overlay on top of the data as well. Because the main market data set is so commoditized, and even the fundamental data set I would argue is quite commoditized, because the source is all single sourced, that they're looking for value add, and that's either platform driven or that's also additional data sets that they can use to supplement market data. And what I find is it's going to get quite crowded. I think in 2021, we're going to see, especially I use Korea as an example, it's just such an active market. On the ETF side, it's going to be very crowded, where I would say 9 to 10 brokers are going to be offering US ETF trading, and they're going to have to fight for differentiation to drive market share. On the back end, what I think they're looking for now is customers are coming back and asking things for like level 2 data, where previously that was never asked for prior. I think they want to know, they want to see the order book when they're on their back end, they're doing their audits. And so that's something that's really come up in the last 18 months, where we've had the requests that existing customers coming back and asking for that, and new customers coming on board also asking for full order book data as well for the US markets. And so we've seen the trend evolve, but I can definitely see on the front end, it's going to be really driven by mobile and faster connectivity to the market, but then offering some enhancements to those customers to really draw them in. And with what we're seeing with some digital banks that have been licensed primarily in Hong Kong to offer these data sets as well, and trying to put it in part of your banking process. And I think we'll see that. We'll see these firms maybe partnering with other firms to offer a more complete financial package, insurance and other things as part of a bundle to reach more customers. And because they're going to have to innovate, otherwise everyone's going to offer the exact same thing.
Yeah, and just sticking on that point of innovation, I mean, to a large extent, technology today is democratized insofar that everybody can access cloud, everybody can access a certain level of data analytics. You mentioned the markets getting very competitive and commoditized. What are firms doing to differentiate? I mean, there's alternative data sources, but if everybody has access to that data sources, any differentiation could be very short-lived, as everybody else could be looking at the same information. I mean, I remember a decade ago that hedge funds started using Twitter information, sentiment analysis on Twitter, but now everybody does the same thing, right? So how are the firms that are going to be successful in the future, how are they going to differentiate in terms of data to maintain their competitive advantage?
Well, what I've seen is firms trying to blend more than just a kind of a brokerage offering. And I'm speaking on the retail side. On the institutional side, the institutional customers that we have at Morningstar Asia are very vanilla in what they offer. So on the retail side, there's a firm we deal with Southeast Asia that tried to create what they call the Facebook of stocks, looking at US and I think Singapore and one or two other regional markets in ASEAN. But they wanted a community. So they wanted to develop that community that engages investors directly and spurs the trading from that. So they look to things like having a professors at some of the universities in the region write information pieces to draw in readership, and then leads to they hope additional stock trading. And so I think that's where I see that happening. You're going beyond just offering the plain vanilla, and I think if you build that customer base organically, then you have the ability to have that captive audience that's going to be coming to you to look for that unique information. And that's one thing where it's worked well. Other things you mentioned, like market sentiment, I think you're right. I think a lot of companies have sought to offer that in some way, or integrating social media into trading. And there's that firm where you can trade. I can trade your trades when you tweet your trades. Then I can log on to auto trade your tweeting trades or something. And so I think that started to be built out pretty robustly. And one thing that I've noticed that some firms don't want to do, and I think it's because of cost, is there is a lot of great information that's been done by other institutions at the institutional level that they do make maybe a pared down version for retail. They're not integrating that, even though there's great signals that are available that could be added to the space. They're not looking to integrate that information. And I'm wondering if it's because the cost of that, and maybe the investor education required to understand what those signals represent, how to trade those signals, is preventing that from taking place. But any firm that actually went that route would actually have a really unique advantage, kind of blending that institutional signals into their retail environment. And that's something that they should be able to explore, I'd say, in 2021.
Yeah, that's really interesting, especially in the context of Hong Kong, as you rightly mentioned, with the digital banks launching. I mean, they have to refine their value proposition, and then within that, what is the particular value proposition around investments and trading as well. That's great. A great conversation around market access. I want to dive into kind of 2020 itself, and I'll come back to you, Adam, on this. I mean, you mentioned kind of the myths and by connecting the subjectivity of what was happening in a lot of U.S. markets in 2020. Can you talk a little bit about what are some of the misconceptions that people may have about U.S. markets in 2020? Let's start off kind of on the market structure side of things, and then we can dig into actually some of the trends in 2020.
Yeah, I would say, a couple of things. On the market structure side, I think first and foremost, from a competitive standpoint, is not so much a level playing field of all the different market centers, right? So I think if you go back and look at the course of, last 5 years, a lot of the regulatory changes were focused on providing more transparency around ATSs, which we did through Reg ATSN. As you know, MiFID II kind of got rid of the BCNs in Europe. In addition, we've seen a growth in other off-exchange vehicles, whether through principal mechanisms, and that could be through wholesalers who execute on behalf of retail flow. You have single dealer platforms / ELPs that execute kind of exhaust, so meaning they go through the smart order router, and then eventually will go to a principal dealer. There's central risk books at brokers where they aggregate a lot of their risk. They disseminate IOIs and try to generate some alpha off of that and get paid for that generation of alpha. And I think a very good way to look at it is ATSs themselves, which historically have always matched buyers and sellers, as in a matching engine. In Q4 of 2019, they represented about 12% of the total market. In Q4 of 2020, they represent slightly more than 6%. So almost less than 50% of the US equity market volume it was decreased from an ETS perspective. So they went from 12 to roughly 6%. So where did all that off exchange volume go? And you hear things like TRF. So I think it's very important what people understand what a TRF is. So that's a trade reporting facility. So anytime I execute a customer order off exchange, they go to the tape. So unlike the rest of the world, the US does have a consolidated tape. And the nice thing about that, when it does execute off exchange, it gets reported. So everything that I just mentioned, you have ATSs, alternative trading systems, you have wholesalers executing on behalf of retail, central risk books that execute, principal flow that are aggregated at various bulge brackets and other banks. Then you have single deal platforms / ELPs, which are very consistent with SIs in Europe. And then lastly, you have other off exchange vehicles that happen. All of that comprises of TRF volume. And when you look at 2019 versus 2020, you saw a significant growth in that. But I think a lot of that was really fueled by zero commissions and the trading of lower price names, where in some of these lower price names, you saw a lot of the activity grow off exchange, where it's roughly 60-70% on any given day. And in February this past year, off exchange hit a record for the full month of 47.5%. I think one of the really key elements that I think are very important to think about as an exchange, we're held to higher standards. And so one of the things we'll learn through our acquisition of MatchNow, and as you know, in Europe, CBOE owns and operates displayed and non-displayed books, but in the US equity market, we can't, right? But if we want to provide innovation, we have to go through a comment period, and we have to go through a very lengthy process to compete for that order flow. So there's a lot of folks that are saying we have too much off exchange liquidity, we need to go away. Our value or our proposition around that is really trying to figure out ways where we can compete for all that liquidity, not only just on exchange, but off exchange. And a simple way of doing that is kind of lessen the standards for exchanges. And one thing that I think is important to note, periodic auctions, which have been very successful for us in Europe, we want to bring to the US to not only just trade for some of the illiquid stocks, but we also think that there's value in Amazon and Google, where you see a lot of non-display liquidity trading within the spread. We think that periodic auctions is a valuable proposition for that. We filed for that in July 27 of last year, and we still have not received an approval, right? So if you think about all these other market centers that have come about, it's a little bit of an easier process for them to be able to compete and get things to market, whereas in exchange we cannot. So I think at the very least, people should understand in context, what does it mean in the US equity market? Roughly 45-47% trades off exchange through these various mechanisms. And then you have the remainder trading on exchange. And for them to be able to compete, it's a pretty difficult proposition. And at some point, we can learn from the rest of the markets globally about how we can have exchanges and off exchange vehicles coexist and kind of level the playing field. So to me, those are very important aspects of it. And then lastly, I think getting back to focusing on transparency will help instill proper investor confidence. Where sometimes, particularly in the US media, we're very driven off of emotion. They want to sensationalize a lot of these issues. So I think it's very important that we take a very pragmatic approach and we evaluate through the use of data, and we come up with appropriate decisions. So to me, those are the most important elements. And CBOE continues to play a very crucial role in doing that, particularly as we build up our data analytical platform, and we leverage that to have discussions with our customers as well as the regulators to kind of educate them and put some context around everything that's been going on over the last 18 months.
Thanks, Adam. That makes a lot of sense. James, I mean, would you echo everything that Adam said in terms of the views of your clients on US equities and the markets there?
I would. My clients, the retail brokers in particular, very respectfully, may not be so articulate in their communication of that point. I think they would divide it far more simply in terms of their own perspectives, but I think 100%. And I think the final point that Adam made there is the one that really needs to be carried forward to retail. And I think there is a role here for those of us that play the intermediary, the interdealer brokers, the retail brokers, the wholesale brokerage venues, that the communication piece needs to align with the goals of the regulators. The goals of the regulators broadly, and I'm speaking very broadly here in the US, in the Europe, and even throughout Southeast Asia, is a disclosure-based regulation when you're dealing with retail. as long as you're disclosing what it is that you're attempting to package up, the way in which you're engaging with clients, that's only seen as a good thing by regulators. So I think more disclosure, more transparency, more optionality, even for retail, would be, in my opinion, a good thing for the industry and a good thing for the retail investors themselves. I also believe, from where we sit in the industry, that the regulators would see that as a very favorable development as well. Bringing transparency is it's very hard to challenge, because optionality and the value proposition that comes with choice, even for a retail investor, I think is there. And what we see now, a lot of the rhetoric and the emotion that sort of is visible in the press and in segments of the retail and even in the institutional trading public, is really driven by perhaps a lack of understanding about what's actually taking place under the hood. And I think that's where all participants in the market, whether they be the exchanges, the market makers themselves, and the clearers, the custodians, we all have a role to play in bringing that transparency forward. Because I do think that, as I said earlier on, there is a place for full fee paying execution services into the US. There may also be a case on an ongoing basis for fee-free executions, but it's a case of representing the value correctly to retail and understanding what it is you're offering to them and why they should take a particular path. And then, as it always comes back, ultimately choice is in their hands. And, I think that's going to be a good thing.
Yeah, that point about transparency is a good segue into kind of the next section of what I want to get into, which is some of what actually happened in 2020. Chris, I want to come back to you now on this. I mean, let's start a little bit larger here, but I mean, what were the top 3 or 5 trends that you and Morningstar saw in 2020 with retail investors, and then with investors in general, but more specifically, I think with the headlines centered around retail and things like payment for order flow, meme stocks, et cetera. From your perspective, I mean, what were the key things that you saw in U.S. equities?
Well, I think for us, like the big driver really was establishing that presence where sourcing out that you want to be in offering U.S. market trading. What I saw is 2020, when the pandemic happened, there was a huge pause, and I would say probably from maybe February to May or so, nothing happened. So there was a lot of, how long is this going to go on? We're going to be locked in our homes forever. And then I saw some companies actually really looking forward and saying, okay, well, this is a good time for us to rebuild or re-strategize, take a step back and take a deeper look at what we're offering our customers, or what we want to offer our customers, and do some capital expenditure and build out some of these infrastructure facilities and really expand our overall offering. Others, no one really withdrew from the market, but others were very cautious. And so I think, kind of a macro level view, the driver was really dependent on the firm and what they saw as the future. And the larger firms did actually make some great investments to expand their offering. In terms of broker connectivity, that was a real big issue for our customers. And U.S. markets are very straightforward. I think there's a lot of ways for them to connect and find their counterparties that they want to execute through, especially local firms. But we got some contacts in where people were already offering U.S. securities that didn't look to additional markets. Things like European markets, and LSE seems to be the first landing point going into European markets, as opposed to like a CBOE Europe. LSE seems to be the first driver of that. And then they actually came to Morningstar and asked for help finding counterparties. There's a great understanding of the U.S. market locally. I would say maybe surface level, but I think there's enough avenues and channels for them to have access. But then you really got into that second part. When we go beyond that, they really don't know where to begin. And so that was one driver that we did see. I would say in the kind of big picture, I think the pandemic sort of led to, are there additional opportunities for us to offer our retail investors, or for retail investors in general, just from listening to our Morningstar experts, talk, are there opportunities within the pandemic that can be exploited to increase my position? And so I think that's what everyone was looking at. I think now we kind of see a light at the end of the tunnel, maybe towards the end of 2021. But I would say in terms of expansion, we really saw that. We really see people start making those investments to expand their connectivity, expand their offering, and really make a more robust offering for their customers.
And following up on that, Chris, I mean, if you had looked, just over a year ago, I think nobody could have predicted what 2020 would have looked like, or did actually look like. I mean, if you went back a year and a half, maybe a little bit before the pandemic really took center stage, I mean, we had these trends around zero fee trading. Then, if you assume that everybody's going to work from home, obviously, well, maybe not obviously, but many people are going to be trading. And so that's been the uptick in markets that we've seen. Was there anything that surprised you about 2020, specifically about the investors themselves, either on the retail side or on the institutional side? I mean, again, you could have kind of predicted people are stuck at home, they're working from home, maybe they're going to trade a little bit more, zero commission. So the barrier to entry, you're just using your phone. It makes it very easy to trade. But was there anything outside of that that really surprised you in the sentiment or the activities of retail investors or institutional investors in 2020?
Well, so some of the drivers that we saw were obviously Tesla had a huge 2020. And it was actually leading those big stocks. And I think that those sort of headlines, and again, the GameStop, those sort of the GameStop type of headlines were more of a novelty. I think investors here were very curious, just talking to people on the street in Hong Kong about their sentiment. And there's always one of the things they want to ask, should I get in now? But it's already at $400. Yeah. And so, but I think what I saw really is the driver then, things like Tesla and, the stocks that still did well and performed well during the pandemic. And that's sort of what drove people thinking around the investing space. And I think that they pushed that back up to the retail. So I think market access, zero commission trading, I haven't seen that really with the brokers here. So I do believe if you sign up for your local broker in Asia, and remember, if you're trading US markets, you're trading the opposite hours of your work hours. So you're going to either set your trades as a limit order during the day, so you might have more time to research during the day as a retail investor, but you're still, those trades are still going to execute overnight. And so I think one of the things that I found fascinating, and I still find fascinating, is the demand for retail real-time data, and paying those exchange fees and paying everything that goes along with that, when it's exact opposite hours trading for 90% of the audience in Asia. There might be some overlap in Australia during different times of the year, but I find it fascinating that the companies are willing to spend that much and not say put their toe in the water first, offer delayed data, and then upgrade to real-time data if they get a lot of interest in the US market. The customers that engage with me the most, I can see where they've seen an increase in interest in the US market. Either the domestic market is small or is tapped out. And so sophisticated investors to kind of gain that access that they wouldn't have had otherwise. And then they have to then promote that. But the driver I saw in 2021 from institutional level was just kind of being able to make that additional investment across more markets than just US. And so and I see that will probably be a trend maybe going into 2021 as well. Maybe looking for additional avenues to expand the offering overall.
Very interesting. A lot of really good points there. Adam, you were nodding as Chris was in agreement, not in terms of falling asleep, but in agreement what a lot of Chris was saying. I mean,
it is late here.
Yes, that is true. I mean, you being in the US, you've seen the best and the worst of the pandemic to a large extent. I mean, my last trip to the US was in March last year, and nobody was wearing masks, and it was just before everything really kicked off. And arguably, won't make comments about the political situation, but you saw the trough of the pandemic really towards middle or end of last year. And now, vaccinations are really picked up, and you have a third of the population that's been vaccinated, and pharmacies have more vaccines. So we're starting to see the end of this. Well, at least kind of this new normal, and us come out of this are a lot of the things that Chris talked about in terms of the trends that we saw in 2020. Do you see those continuing in 2021 as we start to get back to normalcy in markets? And maybe you can comment the situation there in the US, and then we can go to James to look kind of at overseas investor sentiment and activities.
Yeah, I'm not sure if the political climate has gotten much better. I still think there's a lot of emotion that drives a lot of the viewpoints and the rhetoric that comes out of DC. So I'll refrain from my opinions on that one. I would say in general, I would think that if you just look at it from a capital market perspective, there is definitely some concern about the future of the U.S. economy in general, right? Even under the current administration, there's some fears of tax increases, which can have some dramatic effect on price of goods and services sold. In addition, you have other elements where you have firms like Amazon that have really grown quite superior in the pandemic, and have kind of pushed an undue burden on the average consumer, particularly even those of whom that own small businesses. And so I think you find two ends of the spectrum. What's also interesting about firms like Amazon, I think, don't quote me on this, but I think roughly about 60% of the net revenue comes from AWS, which is not so much on the consumer side. So I do envision technology playing a greater role, and you even saw that from SIBO, where we recently announced a global division for market data and access services. So very similar to what Chris was mentioning about getting access to market data or historical data. We want to make sure that we can deliver that to all of our clients through our global network, across every region. And even just to think about what we recently launched in the U.S. equity market, we launched 4 a.m. trading because there was a significant demand by individual investors in the Asia community who leverage platforms like Webull in an interactive broker. So I think it's very important that from a technology standpoint, everyone continues to advance and they expand their opportunity set. And we did that recently with our global market data access provider. There's definitely still some uncertainty in the U.S. economy. One thing that we did see on Monday, there was we saw some inflows in the tech sector, so we saw that activity increase on the option side. But you did also see that on the ETF side. And just to put in another perspective, is ETF today, the largest ETF trading today was ultra short, right? So what does that tell you? That there's some concern about the direction of the market. So I think there's still some uncertainty. Yes, you're right. The vaccination, the precautions that we're all taking, I think is helpful to kind of put a light at the end of the tunnel. And I heard a statistic today that about 23% in the U.S. Have at least received their first part of the vaccination. But unfortunately, the rest of the world hasn't caught up with that too. So I think that until there's some global certainty, I think you'll have a lot of volatility exist in the U.S. equity market. And then lastly, for some things that SIBO are doing, we're trying to cater to that global, access for people to provide market data. And that was similar to the announcement that we just made, creating a global market data and access group. So there's definitely some uncertainty. It'll be interesting to see how it works itself out. But I think at the end of the day, there's light at the end of the tunnel, which I can eventually at some point get out of my basement and have some, physical contact and build the camaraderie that we had at SIBO and interact with some of our clients. So hopefully that comes soon.
Yeah, to be honest, your basement doesn't look that bad to get out of, but I guess anywhere after a year gets boring. Your point about market access, just before I come to you, James, is I want to launch the second polling question we have, the second and last one, which is just looking at how does your firm currently access international markets and data, and multiple choice here on how you're doing that. So I'll open that up to the attendees to answer in the background. James, similar question that what we talked about with Chris and Adam. It would be interesting to know what you're seeing from your investors and traders around sentiment. Just speaking from a personal perspective here in Singapore, we have a WhatsApp group, and a friend invested $10,000 in Tesla. And so he's really proud of himself. And he was blustering about it on the WhatsApp group for a while. And then the next thing he said, he got into GameStop at 400, and that's going to go to the moon as well. And he's strangely gone quiet over the past couple of weeks with that. So I'm just curious, do you see some of those trends? Are you hearing the same thing like what Chris is hearing in Hong Kong about US equities, and what are your thoughts for the future?
Yeah, look, we absolutely are. And I think particularly with some of the political unrest that we're seeing in Hong Kong in particular, even throughout Asia, there is, I think, a renewed focus on the US equity market, as I think, investors have potentially turned away a little from some of the local bourses. I think the initiatives that CBOE actually came out with a little while ago with the Asian markets, we refer to it down here in Asia as the Asian market trading hours for the US exchange, I think is a really positive development. I think that in time, the retail market broadly down here will turn to that market more fully. I think that institutional interest there will probably be aligned with the liquidity. But certainly when you see markets that are rapidly dislocating or, heightened volatility, I think the option to be able to exit risk into the US markets during the Asian time zone will eventually bring in more institutional flow over the weeks, months and years. So for me, I think that's a really positive development. In terms of the retail trends, absolutely. I mean, at the height of the pandemic, our broker community, that is the retail brokers that we serve, were forever asking for margins and financing for a host of stocks that we would broadly refer to as the doomsday prepper stocks, Activision Blizzard, baked goods, tinned goods, emergency and medical supplies, these sorts of things. That thematic absolutely played out. But more recently, I think this community-based and society-based trading has really sort of, I guess, taken the fore. And it'll be interesting to see where this lands, whether there is any regulatory intervention at any point with respect to this style of trading, or whether there'll be just enhanced scrutiny, enhanced market surveillance by both regulators and lawmakers. Will be really interesting to see. Certainly the level of attention that has been garnered, justifies a certain level of discord and discourse amongst, those groups, the regulators, the legislators, and indeed, those of us in the financial markets. Because I think this is something that is going to increase, this social investing, this social activism, basically playing out through the capital markets rather than through some more traditional democratic channels. It feels, at least for now, like that sentiment is only growing. And I think the ease of access that is now available to retail through these online apps and the more mobile devices is only going to fuel that society and community-based investing. So I think that is a trend that we're going to be living with and interacting with for many years to come.
Yeah, that's a really good point. We're almost out of time. Maybe Adam, I can come back to you quickly. I mean, James brought up the issue of regulatory oversight. You talked about the regulator's approach to many of these markets. I mean, don't necessarily need to comment on what we're going to see, but do you think that there will be regulatory action around some of these things? I mean, we haven't had a chance to dig into it deeply, but payment for order flow, the way that kind of the social and community trading. What do you see as the future of regulation around that, or do you think regulators will be hands off?
The way I would look at it is if there is historical precedent about how regulators react. So if you think about the U.S. equity market, everyone remembers the flash crash of 2009. We had the Treasury flash crash in October 2014. We have the ETF flash crash in August of 2015. And I think out of each one of those scenarios, the regulators took a very pragmatic and a methodical approach about launching regulation. So we have limit up, limit down. We had Rule 201, Rule 204T. We had Reg SCI. We amended a lot of the prior rules as well to be more consistent with the current market structure to help avoid certain scenarios. And it wasn't something that they just reacted right away. It was something that they had the industry come together, evaluate some of these market structure related items and leverage data to make informed decisions. So hopefully they take that approach, right? You can see as each of the hearings, I'm not sure how many folks have listened to it, but if you listen to the first House Financial Services Committee meeting, it was a lot more direct, if you will. You get to the Senate meeting, a little bit less direct. And I think the third meeting was a little bit more detailed, more focused. People trying to put things into context, really understand everything. So you're always going to have certain ends of the spectrum where people think it's terrible and these are things we need to change right away. So, at some point, Gensler will, we're assuming he'll be approved as the head of the SEC, and then there'll be a head of the Trading and Markets Institute. And and I think if any lessons can be learned, that the regulators can act appropriately, but I do think that they have to evaluate the data and leverage, their historical precedents there to be informed about some of the decisions that they're going to make. I don't envision anything as significant as, say, like a MiFID II change that happened in Europe, in the U.S. Potentially that the U.S. would just go back and focus on improving investor confidence through greater transparency, which they had over the last couple of years with enhanced rules around order routing disclosures, as well as ATSN. So that's my general viewpoint on it.
Yeah, great points. Unfortunately, we're out of time. I just want to share the results from the last poll that we did. So again, the question was, how does your firm currently access international markets? And 57% of you said direct connectivity to the exchange or data source, which is, I guess, Chris, maybe final comment, would that be expected, or is that higher or lower than you would have expected?
I would expect that at the institutional level, but I would be surprised if this is for people with a retail offering. Because I think one of the great things about vendors is we can normalize that data across the various exchanges globally. So for a single market, it makes sense, but for multiple markets, I would assume that most would go through a data vendor like Morningstar. But yeah, I'm a little surprised by that, but I don't know the composition of the audience, so I should say I'm not 100% surprised.
Great. Well, thank you so much to our panelists. We've lost James, but Adam and Chris, thank you so much for your time. I think this has been really insightful. Unfortunately, we're out of time for this. Thank you as well for all the attendees today, or if you're viewing this as a recording later on. We will send a follow-up with details about how to reach out to Cboe, Morningstar, and VAST. So feel free to connect with any of them to find out more about trading U.S. equity markets. Thank you again for your time, and look forward to seeing you on a webinar again soon.
Thank you.